Now, at this point, what I want to do, and I'm doing this for a couple of reasons. I think the case study that we did was really popular, and I think everybody learned a lot from it last week. So I'm going to put case studies in each session going forward, at least one. And I think it's a good idea to do a case study on market structure, market condition, because they're critical concepts. You hear me say market structure, you hear me say market condition, you hear Troy say the same thing. And we talk about it. I don't want you to be sitting there wondering what it is. I want you to immediately understand these concepts because they're important. Because this is really the essence. So this is part of the essence of what we're doing. It's critical. So what's the market condition here? It's up, yeah. But beyond up, what is it? Raj, that's good. It's biased up, it's two-sided. Yes, that's about as accurate a description as you could give. Now, is there anything that I could slap on this chart that would clarify that would help me make a decision about what to do here? Let me ask you this. If I'm not in this, if you're not in this, what do you do based on this chart? Kim, you wait. Why do you wait? Raj, you do nothing. Why are you guys doing nothing? What's missing here? You know, what's missing is context. You don't know if this is a daily chart, an hourly chart, a 2-minute chart, a 1-minute chart. You have no idea what happened down here. This is useless information as it's portrayed right now, right? Isn't it? Do we agree with that? If I'm not in this trade, I don't have a clue what to do here. I wouldn't touch this based on this. Now, does this help? Here's a lot more stuff. We've got volume here. We've got stochastic, and we've got a MACD down here. Now do I know what to do? Well, why not? But I didn't know what to do here, so I put indicators on here. Aren't these indicating what I should be doing? No, and the point of this is that I don't know more about what to do here with this stuff under it than I do here. And why? What's missing? We have to see the bigger picture of market development, the market structure. That's what drives any decision that I make about this. You don't make these decisions in a vacuum. And you can't use this stuff, doesn't tell you anything you can't tell by just looking at it itself. You guys don't have to agree with everything I say. Somebody argue with me. I like to argue. I have 4 children, an ex-wife, a wife. I'm an expert in arguing. Okay, market structure. All right, Skip, here you go. Raj, I seldom win with my significant others, but it makes me tougher in the outside world. How's that? So think of market structure as something that's concrete. It's something you could proverbially touch, a balance area. It's a high volume node. It's an upper or lower extreme. It's a previous days or second days back high or low. It's an intermediate long-term market high or low. It's tangible, I guess. Market condition. Now, market condition, think of it as defining current price action. It's trending or initiative. It's consolidating or balancing. A market condition is involved in creating market structure, but it's not market structure itself. So does this help? So market condition is the price action that's dominant under a given market structure. A balance area that's forming is rotational. That's a market condition. A trending market, an initiative market is more condition than structure. The structure manifests itself in, verticalness. Balance is an auction market structure. Rotation is the dominant auction market condition of balance. Imbalance trend is a market condition. This is key. This is critical. This is critical. Strategies, tactics, and money management are determined by one or the other and sometimes both. This is why the trade setup thing that everybody obsesses over out there is so trivial. I mean, a trade setup is just trivial. If you understand this, and we're going to get into the trade setup thing, you'll inherently see that the trade setup is really not that big a deal. But it's ironic. I mean, almost the entire trading education industry is focused on selling you the trade setup, but there's nothing behind it. Okay, market condition. This is the ES, obviously, and this obviously does not include the day's trading. But actually, it would not change this, except it would change the short term. But when I made this chart, I think I made it yesterday. Long-term, intermediate term, and short-term market condition of the ES is initiative up. Now, if I know this information, I can trade this market. I can come up with a reasonable strategy and reasonable tactics that fit when I can get this information. This is an incredible amount of information. It tells me the path of least resistance to the market. It tells me what is a logical level on a retracement, on a counter trend move, because this is up. It tells me the reasonable way to manage a trade if I fade the market, if I sell the market, where I should be looking to get out, and how long I should be expecting to hold that trade and why. And it also tells me if I go long, the best place to go long. And it also helps me to identify if I go long, if I trade with the greater degree, line up the market conditions where I want to be getting out too. So this is the information that you need. When you look at a chart, by the end of this course, you should be able to look at a chart, any chart, and know what you would do the next day if you had to trade that market. You would know, you should be able to say, well, maybe this isn't an ideal market, but if I had to trade this market, this is what I would do. And ideally, every single one of you would come to the same conclusions about the if and or buts to trade that market, what you would do, what you wouldn't do, the quote-unquote resistance levels if the market's in a downtrend, the support levels if it's in an uptrend, what you would do if it was in balance, where the extremes were. You should all be able to look at the same chart independently, just random charts, any chart, and make that determination. And that's a really powerful tool, and it's an ability that's not without, not outside reasonableness, that by the time you finish this course, and in a couple of weeks at most, as you get comfortable with this, you should be able to take any market and look at a chart, a bar chart, and get that information. Robert, what is your question? You say, why not always both? I didn't see your question in time, so I'm not sure what you're referring to. Okay, so I did answer your question. Okay. I'm trying to keep an eye on the chat, but sometimes I'll get going here and Okay, now this is more analysis on the ES. The downside short-term market structure that is critical to the bullish assumption market condition is the area near 1515. A close below this area should not occur based on the bullish assumption and the fact that the day's breakout is potentially just beginning an initiative phase and should continue higher market condition. So we knew coming into today what shouldn't happen under a bullish assumption. And we will revisit what did happen, but that's outside the realm of the immediate case study. But coming into today, you knew this information, and you can go back years and look at DBSAs, and you see the same analysis based on the same structure. Now this is the 212 through 217 auction. It's a mature profile. Now mature profiles are the most important structure, market profile structure to an auction market trader, because it identifies a very specific market condition, and it is a market condition that gives us the highest expectancy trade, and it drives trade strategy, it drives the tactics, it drives the trade management, the stops, the targets, profit taking, et cetera, et cetera. So a mature auction, a mature profile, a profile and auction are synonymous. You guys understand that? A mature auction, a mature profile, composite profile has one and only one correct trade strategy. This is one of the times where, you know, there really is one correct answer. You want to identify and take the initiative trade. This is one of those absolutes. And there are not too many absolutes in discretionary trading. This is one of them. So why do we want to do this? Great profit, yeah. It's the, Kim, that's what I'm looking for. It's the highest expectancy trade. Well, you say great profit, low risk. You know, profit and risk are relative terms. Expectancy is sort of the equation that puts those two variables together, the profit and the risk. It is the highest expectancy trade. Now, it's not, and this is important to note, it's not the highest probability trade. The highest probability trade are the responsive trades in a range. You know, the initiative trades, you get false breakouts, you get range extensions that don't follow through. You know, all of this is part of the aggravation of taking the initiative trade. And it's part of the reason that so few people want to trade initiatively, because they want the feel good. They want the high percentage of winning trades. They have not conditioned themselves to understand that a single trade in the big picture, the result of that single trade just doesn't matter. And, you know, you start counting money. Well, I've had 2 losses in a row. I just, you know, these initiative trades just don't work. Well, they don't work until you have a day like today, and it does work. And if you catch an initiative move like today, it more than makes up for the last 4 times that you tried an initiative trade and you got stopped out by, you know, 2.5 handles or something. You know, if you trade this, if you take initiative trades, you're a superstar if you can get to the point where by some savant-like ability, 50% of them work. The reality of this is that for most of us, taking the initiative trade, fewer than 50% of them are going to work. Somewhere, I don't know, between 35 and 42, 43% is probably normal, I'm guessing. But that's, if you consistently take initiative trades, if you get 35% of them, you will be spectacularly successful. Now, you can do the math, and if if only 35% of your trades are winners, that doesn't necessarily mean that every third trade is a winner. It does mean that you are exposing yourself to streaks, because it's not, okay, 2 losers, winner, 2 losers, winner. That would be nice. Unfortunately, it's not that way. It doesn't work that way. You're going to have, this is a loser, 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 winner. Loser, loser, winner, 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 loser, 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 that type of thing. So it's 35% over a large sample of trades. The runs within the sample, for you gaming theory students, are going to be random. And you can work it out mathematically, the probabilities of 4 losing trades, 5 losing trades, 6 losing trades with a 35% probability of success. But that's, we don't need to do that. But the point of this is that, I'm just being candid with you, you need to understand, most of your trades are probably going to be losing trades trying to take initiative trades. It's not like this is the immediate holy grail, and you can all go out and start buying stuff, shopping online like I do when I'm in a winning trade, which is always the death of that winning trade. So you just understand that. Now, that said, you never want to take a trade where you can't afford the magnitude of the risk. You should be able to withstand 4, 5, 6 losing trades in a row. I don't care what methodology you're using. If you can't do that, you're over-leveraging yourself, or you have over-leveraged yourself. Because the reality of trading is, guys, you're going to have multiple runs of losses. There is no getting around it. That's an inconvenient truth about trading that is not popular, and it's certainly not popularized, but it's just the reality of trading. It's a business. And it's not one discrete trade, it's not one day, it's not 1 week. It's a month, it's a quarter, it's a year, and you have to steel yourself to the realities of the business aspect of it that requires having losing trades. It's just part of the business. Now, the reason to take the initiative trade, in spite of all the things that I've just said, and I try to give you guys the unadulterated truth and reality of trading. I'm not trying to scare you. That's not the intent. The intent is if this is a business, it's a profession, there are certain realities. It's not easy. There are things that you're going to have to train yourself to do that aren't comfortable, but it's just the reality of it. If you want to trade and sustain yourself and be a self-sustaining trader, some of these things are not going to be naturally comfortable things that you're going to go through. So I want you to expect them, so that when you start trading this and you have 2 or 3 losers in a row, you're going to. I don't want you thinking, well, Tom said, I had to take these trades, but hell, none of them were working. Why would he say that? So I'm going to tell you up front, a lot of them aren't going to work. And Troy and I both try to show you guys in the live room all the time the trades that we take that don't work, because we take a lot of trades that don't work just like you do. But if you learn over time, once you catch 1 or 2 of these trades, you'll get it. But, invariably, when someone starts trying to reorient themselves and they've been trading a different way, they've been taking quick profits. When they start this, they begin to have all these self-doubts because I had a loser, I did exactly what you said, it was a balance area, I took the initiative break, and it stopped me out, or it reversed, you know. Well, that happens to me. I've been trading 28 years. It was probably going to happen to me again tomorrow, but I'm still going to do it tomorrow and the next day and the next day. So this trade is so important. This is the trade that I was talking about earlier, where if you will train yourself to understand the basis for the trade, to recognize the trade when it sets up, and the setup is a mature balance area. And then if you will understand the realities of it's not going to be a winner every time you take it. If you will be disciplined and you will take this trade, the ones that set up that you can afford, okay, that you can afford the risk of, it will be difficult for you not to succeed. I can't underemphasize this. This understanding this trade and taking this trade is, quite frankly, in the long run, it's the easiest way to succeed at trading. It's the most difficult thing to learn to do consistently because it's uncomfortable, and on some levels it's counterintuitive. And part of the reason it's uncomfortable and counterintuitive is because the trading industry and everybody out there is preaching having a high percentage of winning trades and all this other stuff, and trading is easy, and you know, you don't have to be, it doesn't have to be painful for you to trade, and a lot of things that just aren't true. Now, you know, the discomfort, trust me, after you catch a few of these trades and your account equity starts to grow, your comfort level will increase dramatically. Okay, so here we are. Here is a mature profile. Globex has completed, and we're trading right here. What do we do? Okay, so Raj, let's assume, for the sake of argument in the example, that you know you can get a trade off. You're going to go long at 15.19.5, and you're going to put your stop at where are you going to put your stop, Raj? At the Globex low. So you're going to put your stop down here, right? Somewhere down here, below here. So you're going to put your stop, let's just for the sake of round numbers, let's call it at 15.15. Okay, that's a 4.5 handle risk. What's your expectation for this trade? You're risking 4.5 points per contract. And so your target is 17. Where are you coming up with 17? Oh, your stop's at 17. That's what you're saying. Okay. Oh, okay. All right. So what's your target? What's your target for the trade? You don't know what it is, but well, what's the basis then? If you have no idea what your target is, yeah. The answer is, if you take this trade here, your minimum expectation is 15.22, right? Now that's not very far up from here, but the reality is that's not what take to 15.22 in a mature profile. That's not what you're trading for. If you take this trade, you're basically jumping, quote unquote, the initiative move. You're saying, okay, all right, Globex is balancing here a little bit above, you know, the lean here in Globex is the development appears to be higher. I have a mature profile. I think it's going to try and break out. I'm going to go long here. Now, you've got your stop at, let's say, 15.17. What if your stop's taken out? What are you going to do then? You're probably just going to sit and see what's going on, right? Because and you know, I wouldn't have a. This is one of the examples where I can see, I could live with you saying a 15.17 stop. I think Troy said below the Globex low. And I actually did take this trade, but I didn't have any heat, so I didn't have to answer the question. But when I enter a trade like this, I'm expecting it to go higher immediately. And I'm probably, Raj, I'm like you, I'm probably going to put my stop below this high volume node. You know, I have essentially rejection here. This is sort of a buying tail. And then you trade back up through here. You tested the high volume node, the Globex session here. And now you're building a little balance area on top of all this. So I really don't want this area to come out. And if it does, my trade is invalidated and I'll regroup. But I don't, in this particular instance, I wouldn't quibble with saying, okay, I'm going to put it a stop below the Globex low. Ed, you say this trade is in the middle of noise. Yeah, but it's in the middle of noise, but what's the bigger market condition? Remember, we have these phases of development in all degrees of time all the time. But I think the more important piece of information here is that, yeah, you have, this is in the middle of noise in this section, but what has preceded this is, the primary overriding thing that we trade is market condition. This market condition is saying I have to be trying to get an initiative trade. Now, I don't have to take this entry. That's not what I'm saying. But I have to be looking for the initiative situation. And I trade that situation based on my understanding and comfort level with the material at the point in time that I'm making the trade decision. So I'm with Raj, and I did take this trade. I'm going to, if I see this, I'm going long, but just based on market condition. And is it in noise? Yeah, in this minor time frame, but I'm expecting the signal ratio, I guess, if we're talking signal to noise, to pick up here, because this is all noise. But we've got a market that is trading above the high volume node, as Troy pointed out up above. And the general rule is you want to be taking trades on the price side of the high volume node when price is near the high volume node in an initiative situation. So this sort of fulfills that. Now, I admit, this is how I trade. I'm not saying everybody needs to trade this way. But if I think a market is mature, I'm looking for reasons to get on board that initiative trade. And really, think about this. I'm increasing the expectancy because my risk is actually better defined. My risk in this situation, if I go long here, is no more than if I take a breakout. If I take a breakout, I'm still going to have to use, 2.5 point stop or something, which is roughly what this is. But what I am doing by getting on board early is that I'm increasing the potential return. Because if this market does indeed break out up here and it trades initiatively higher, then, I'm ahead of the game. Now, it's sort of a trade-off because a lot of these and you guys have seen me, if you've been around long enough, you guys have seen me in the room before. As a market looks like it's breaking out, if I see it, I take the trade. And I get stopped out a lot. But that's just my style. If I know that if I catch a few of these initiative trades a week, I'm going to do real well. So I'll take my lumps. I'm willing to do that. Now back to the target. Initiative trades, there are times where they'll have a target, but really you need to accept that an initiative trade has an inherent edge. And that has been proven by Don Jones. Don did this very extensive study, and it's an ongoing study, where he just wrote, he has a program, and it's, what does it call it? It's, some of you guys have subscribed to Don's stuff. Gosh, what is it? The thing he puts out every night. What's it called? I'm drawing a blank. It'll come to me in a minute. But he basically screens for his computer-defined definitions of balance. Advice engine, that's it. Thank you, Ed. And he just has, 15 markets that are in various phases of balance. And if it hits the 3 TPO count, it triggers a trade. And, over a bunch of trades, a very large sample, it has a positive expectancy. Now, and Don will also tell you, and it's in his work, that, that's not to be, his advice engine isn't to be rote traded. It's just to point out markets with the best opportunity. And I've also said this, I want to give attribution where attribution is due. My work is very heavily influenced by what Don has done because he has done such rigorous work. But what I'm trying to do, what I'm trying to get you guys to do, is to really fine-tune that gross model that Don produces every evening. And this is an example of it. Okay, so are there any questions about this whatsoever? This is really important, basic stuff. Yeah, it's an amazing thing, Raj. I don't know if you've studied that work, but it's really amazing. Okay, Robert, Christine, you guys speak up. Do you get this? I want to know. Yes or no? Michael. Well, Robert, I'm going to show you bar charts in just a minute too, okay? You're new to market profile. It can be, you're drinking through the fire hose, so to speak. It will become clearer over time, but I'm going to show you bar charts in just a minute. Look, Christine, Robert, you guys stop me if I start going too fast and talking too fast, or I'm not clear. I'm serious. Now, you'll be doing all of us a favor. And the other thing that you're hearing here, Robert and Christine, you will hear this over and over and over and over from me and from Troy and the DBSA and the reports. So it's not like this is the last time you're going to hear it. Everything that you're seeing and hearing in this course is what we trade and is in the reports, and it's the basis for the analysis. So it will constantly be reinforced. It will be reinforced in the trade lessons. It's going to be reinforced in the member webinars. So don't think that, this is your last chance and you're never going to hear it and you've got to go back and memorize everything in this, just this. I do encourage you to review this, but this is not the last time you're going to hear or see this stuff. Okay, Robert, just for you, a bar chart. Okay. Now this is this. And Globex here, this is just before This is the minor balance just before the day session. Here's the 1519 half. Here's the high volume node of the larger structure, and here's 151675. So what you have this is a beautiful example of market condition and market structure on display, and trade strategy, trade tactics, and then in a minute trade management. Now the trade strategy in this situation we've already stated is clear. You're looking for the initiative trade. The tactic, the specific tactic, which is an entry component. Now there's more variability in there. There's more. There's not one answer. If I see this, I'm going long. I don't care if I get 1875, 1519, 1975. I don't care, because that's not where the edge is. The edge is getting in here, and then it's either initiative or it's not. And if I get stopped out of this trade and I didn't get the perfect entry and I paid 2 ticks more, it just doesn't matter. Now, I could, if I chose, I could say, all right, well, I'm more comfortable letting the market put me into the trade. So I'm going to buy it on a breakout above this minor balance area. That's another way I could enter the trade. I could say, well, I'm really going to be, really want more confirmation, and I want it to break out of the entire structure. So I'm going to put a buy stop at 1522 half. And there's no one right way to do it. I do think that as you gain experience, let me put it this way. Most people, after they gain experience, will begin to more and more identify the situation as early as they can, and they'll take the trade. It's not unreasonable here. We don't predict, but it's clear as a bell. Present tense, the market condition. This is a mature balance area. This is a mature balance area in this time frame. There's an initiative situation brewing here on 2 or 3 time frames. There's a huge expectancy. I'm taking the trade. Now, just for the sake of argument, if I went short here, where would my stop bit go? If I went short at 1519.50, it'd have to be 22, 75, 1523, right? And what I would be doing, I would have to, my thought process, that would be a responsive trade, hoping that the initiative situation was going to develop down. But that would be ignoring some pretty compelling evidence that I want to be biased to the long side, wouldn't it? Because, first of all, you have the rejection down here from Globex, and then you have a balance area forming on top of the high volume node, and certainly well above the high volume node. So that's pretty compelling evidence that I really should be leaning long in this situation. And then this is what happened. Now let me ask you this, and you're try not to be influenced by the fact that the thing traded all the way up here. But let me explain what happens to most traders. Let's just take a hypothetical, and some trader that doesn't know what he's doing, and for some reason he goes long, and he's rewarded and gets this wide range bar right at the opening, and oh my gosh, he's got 4 handles of profit. And then this market begins to retrace, and it comes back in, almost 2 handles against him. He's out, baby. He's out right here, and he's happy as a clam because he made 1.5 points, right? I mean, isn't that what happens? That's what happens to most traders. And the reason it happens to most traders is because they don't have a basis for understanding the implications of all of this. Is what drives the expectation for this. And it is also what drives the money management and the tactics once you're in the trade of managing that trade. Now, there are going to be times, so I can't remember, it was fairly recently, I can't remember the trade this happened, but, and you know, this is going to happen. Now, if I get in this trade here and this first 30-minute period completes up here, right here, what am I going to do with my stop? Where's my stop go? Somebody tell me. Should I, you know, put it a point under this bar? Raj, you say above the balance area. Which balance area? At 23? So you're going to put it right here? Kim, you say you're going to go to break even. Why? Well, a couple things. Raj, your answer is wrong. There's no gray there. It's wrong. Don't do that. You've got to give these things a little more room than that, because the path is not always as vertical as this turned out to be. Kim, I like your answer better. In this particular case, you should not see this retraced. The reality is the trade probably isn't invalidated unless it trades below 15.18. But also the reality is, the probability is if it trades to 15.20 at this point, it's going to trade to 15.18. I can see, I can live with, if you get in at 19.5 and this market takes off, that psychologically, and then quite frankly in this particular instance, if it comes back and takes you out at break even if it trades higher, that you didn't do, you know, I don't have a problem with that, because it really should not. And you can live with leaving a stop here. But Raj, if you're putting your stop at that close, you're going to miss a ton of really good trades. Now, this is an area where everybody wants me to give them the answer, and there's not one the answer, except Raj. Raj, you're wrong. You don't want to see the conviction retraced. And if you put it in this particular instance, Kim, you know, you actually, the entry at 19.5 is where the conviction began. So if it's retraced, in all probability, the trade's invalid. Most initiative trades that work are not going to retrace all the way back to the breakout point. Some of them will, but most of them won't. So you can live with the ones that stop you out by a tick or two and then resume. If that works for you, I can live with that. Robert, you say, in hindsight, you see the reason, but from a profit standpoint, wouldn't it be better to take some profit and then re-enter again? Well, there's only one problem with that. And this is it. Let's say, now this was the session open at 9:30. So let's say you entered a short trade here as the market began to trade lower. And then the ES trades down here, and then it begins to balance in here. And, you know, you take some profit here because you're going to re-enter later. Well, you're still waiting. That's the problem. You don't know the path the market's going to take in an initiative situation. And if you're trading one contract and you enter here, I can understand not losing money on this trade, but you're not going to get anywhere taking two-handle profits. You're going to have to grit your teeth and catch the occasional winning trade. You know, this is something, especially in the stock indices, you just don't see very often. A 14 handle drop without an overlapping 30-minute bar. I can't remember the last time that happened. So that's the problem with taking the partial profit. You know, the partial profit in the reentry is obvious in hindsight. I mean, you know, if you could sell this and then buy it back here. But now think about this. Okay, this is two handles. You say, well, gee, that's $100. I'll just get out and get back in. But you're not going to get the perfect entry here, and you're not going to get the perfect entry here. And you're lucky if you don't end up botching it, and you're worse off than you would have been if you just sat with it and sat through the retracement. We'll talk about that, Robert. I think there's some things that you might can do. Now here's the 5-minute chart, and this is what we were looking at earlier. And if you are your typical day trader, not only are you, if you happen to have the good fortune of getting in here, you're probably out here. And then you start fading the market all day long, and you just get ground and shredded and pureed into fine mush on a very directional day. This is a great example of a market that is strongly directional, but it shows you the rotation, and this is typical of the stock indices. I mean, these are two-handle ranges in here. This is noise. You can't trade this. You have to be trading the bigger, more important structure and condition of the market to make money trading. If you're an S&P day trader and you came in and you didn't catch this move, and this is where we started with this, and you looked at this, you don't know what to do, and there's not really an edge in here. And this is just, it's not going to help you. All this does is encourage you to do stupid things. Because you start looking at this thing, oh, it's diverging, it's overbought, I'm going to short it. Now, this is why everybody but you guys lost money trading this. You had, you know, we got in this trade right here, 19.5, right? And the reason we took the trade is not because of some, you know, cute setup here or oscillator or moving average cross. We got long this because of a bigger picture of market development. So we're looking for an initiative situation. We know the potential for this trade is outside the range of this one day. And if the average true range coming into this is, I don't know what it was, 12, 13 handles, then our minimum expectation for this trade is 12 or 13 handles. And on top of that, when you're in a balance area, the initiative move out of that balance area will more often than not exceed the average true range up to that point. So about the only way if you're trading the stock index futures that you're going to capture what there is to be captured is to understand the market from the perspective of an auction market trader and market condition and market structure and market development. And then you will understand that you can have a strongly directional day, but most of it is going to be noise. This is a 2.5-point range. It lasts 90 minutes. This is a 2.5-point range, 2.5 hours. A 2.25-point range, 2 hours. And you were here. Remember, I've said many, many times, I'll say it many, many more times, your primary job as a trader is to do nothing. if you entered here and the market's moved up here and you've moved your stop from wherever we had it, 17.5 to break even, you've done your job. That's it. There's nothing else to do. You sit there. Or anyhow, if you want to add to the trade, there are other things that you can do depending on where you are on the curve. But in general, you've done your job for the day. And what most traders do, they miss this move, so they come in and they're afraid they've missed it. So they buy here, the market spikes up to here, it starts trading lower, they get out, then it spikes up, they buy again here, they get bored, they get stopped out, they make a tick, they lose a tick, then it trades up here, they chase it, same thing over and over all day long. So at the end of the day, they've lost money on a day, and they may have been only trading from the long side, but they've still lost money at the end of the day because they don't understand what's going on in the market and what's normal in a market, even what's normal in a directional market. Now this is each one of these letters is a 30-minute rotation, but with a 5-minute slot. Okay, so this is basically, it's a 5-minute profile. Each profile is 30 minutes. Now this gives you the view, and it helps you see the order of what's going on. Your average trader looks at this, and Robert, I'm sort of talking with you now. This is noise, but you need to be able to, at some point, look at this, and you're seeing what's going on. You're seeing this. Other traders aren't seeing this. This is what we're trading. We're trading the auction process. Other traders are trading the noise. An example of changing your perception, and we look at this chart and we see one thing. Everybody else is out there looking at this chart and they see something totally different. I don't know if you guys, and I don't know what they're called. Some of you will know what this is, but there were the posters back about in the early 1990s. They'd have these kiosks in the mall, and you'd stare at this landscape. Be a farm landscape or something, and you'd stare at the wind vane, and if you stared at it and you focused, then the picture would change, and you'd see something totally different. You see, unicorns jumping over the rainbow instead of a farm landscape. And so this reminds me of that. You look at this, and there's something else beside the obvious that you have to see to be able to trade it. And nobody else sees it because they're not thinking that it's there. So they have no basis for seeing what's there. So this is the auction process, this noisy chopping around that occurs. So this is what is going on most of the time. You're forming these minor auctions. Remember, the auction process is in effect in all degrees of time all the time. So here are your miniature auctions occurring. And this is actually it's over 90 minutes because it started here. You had a stopping price here, and you had development around that price. Then you transitioned higher, you had a stopping price, you had development around that price, had a transition higher, stopping price, and development around that price. Does that sound familiar? Remember the three-step process? Here it is. Kim, you asked a question. Was it required that your entry at 1950 was inside a balance area above the bigger HVN? What if it was above the high volume node but not in balance? Still enter because it's above the HVN. It's not a requirement that it was in an HVN. That was a very convenient situation. But you'd be surprised how often that will show. Now, and would you enter if you didn't have that balance area? Well, maybe. I'd have to see the situation, but you would certainly want to be, if you were entering, you would want to be entering long if you're above the high volume node. Here, let's do this, and then we'll take a break. We're almost through this session. I want to answer your question, Kim, see if I can answer it. Let's just go back and find some other balance areas. All right, this was the balance area before this one, right? And what this market did, you really didn't have a nice high volume node near the midpoint. You started balancing up in here. But if you look at this, and I don't know what time this was, well, this was 8 o'clock in the morning. You did have this little balance area that formed here. So if you had recognized this, you certainly had opportunity in here to enter before this breakout occurred here. So that's one. Let's see if we can find some others here. This was a balance area. So here was a little balance area here. I don't know, again, let's see what time this was. Well, this was 6 o'clock in the morning. This was 7:30. So this was 8:30. So see, that if you came in at 8 or 8:30, you had to make a decision. Am I going long or not? And I would not have had a problem going long, frankly, if I'd seen this. But Kim, this sort of shows you're not always going to get. I mean, the situation we just came out of was a real nice, neat, tidy with the bow on top situation. But you're generally going to be able to find, as a balance area matures, you'll be able to find the smaller degree balance areas within there as a lean. But here's the situation I think you're referring to, where, okay, so Tom, you come in and you see this thing spiking higher and you notice it right here. Do you go long? The answer is yes. I would go long. You don't, you need, each of you individually need to trade right now. I want you taking initiative trades, but I don't want you forcing things. Take the trades you understand and you recognize. And the trades you don't take, mark them. Okay, I've encouraged you to keep your, to annotate your trades and capture your charts. Circle the situation. Say, I didn't take this trade. I wasn't comfortable, but I thought it was going to break higher. I would have taken the trade here, and mark it, capture it, and file it. And then over time, if you don't take an initiative trade for the next month, if you do that, that's a way for you to begin to develop a comfort level with whether or not you're recognizing these trades, and whether or not, if you had taken all the ones that you had seen over the past 30 days, what the result would have been. I mean, that's a great exercise. Robert said it'd be a great thing for you to do. Yeah, and Troy brings up a really good point. You never take a trade that you can't afford to take. And it's not about, this is a trade where I'm risking one to make 10. It's if you can afford to risk the one. We don't want you trading money because you can't trade money. But the reality is, if you can't afford more than X, then you don't take a trade where the trade is invalidated beyond X.